Welcome to the Market Huddle with Patrick the Content Machine Serezna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's March 29th, 2019, episode 21. I'm Patrick Serezna.
And I'm Kevin Muir. Thanks for joining us this week.
Now, this show is broadcast as both an audio podcast and as a video on YouTube. So if you're enjoying this as a podcast and you feel like you're missing out on the charts and videos we're referencing, you can register at the markethuddle.com website to get the weekly email, which includes the chart pack and video links, or just flip over to YouTube.
In this week's episode, we are joined by Kieran O'Dea, hedge fund manager / former elite world-ranked video game player.
And then we'll have a special second guest with Ari Pine giving us a lesson on the unintended consequences of outlawing spoofing.
In our This Week in Trading History, we go back to one of Ben Bernanke's most famous speeches.
And then we get to the top 5 most important things to watch next week. So let's jump right into it.
Kieran, thanks for joining us this week.
Oh, thanks for having me, guys. It's great to be here.
All right. So before we get into all the good content, Kevin, who is the show sponsored by this week?
Well, this week is a little bit of a religious flavor for the beer. It's a St. Mary Axe, and it's an Indian pagan ale. So I don't really understand that. Let's open it. It's nice.
Well, that's actually a really good beer.
Yeah, so let me just tell you a little bit about this. St. Mary's is brewed under the direction of renowned brewmaster Alan Pugsley. Alan graduated from the University of Manchester, so he's English, but then he's moved to Canada, and so he's now brewing in Canada. The thing about it that's most interesting is that the name was after St. Mary's Axe was a former medieval church in the old city of London, England. Now, the original church was called St. Mary St. Ursula and her 11,000 virgins. 11,000.
Nice.
Yeah.
Nice.
I don't get that. I think it's actually now that famous building, the Gherkin, is where St. Mary Axe is in London. So that's where next time you're there, go there and think about the 11,000 virgins.
That's exactly what I'll be thinking.
Yeah.
But it's actually a really good beer. I recommend this one. This is
okay.
I don't say this in very many shows, but I actually really enjoy this.
Yeah, Kieran, you have to understand one thing. Usually Patrick is, by this stage, has already insulted the sponsor. Now, Kieran's actually in the States, so we can't get him St. Mary's Axe because there's a little thing about the sending beer over the border. So you're drinking something else. What are you partaking in today, Kieran?
Well, I have some Hawaiian vodka and water. It's all I have in my house right now, so that's what I'm working with.
So what is Hawaiian vodka?
I'm not really sure. I picked it up in Maui last year, and this is the first time I'm opening it. So it tastes pretty good, though.
How's
so
it
basically,
taste?
you were just desperate, and you were just opening the last thing that wasn't already drunk. I like it. You fit right in, Kieran. Okay.
All right. Well, listen, Kev, get that disclaimer quickly out of the way, and
right.
let's get to the show.
Yeah. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decision regarding topics mentioned in the show. For more information, please visit eastwestfunds.com. Side effects of too much market huddle may include acute exacerbation of chronic nonsense, winorrhea, and or microdechia.
Holy smokes! I'm suffering way too much huddle.
Yeah, that's right. Please see a doctor if any of these conditions persist.
I'm making an appointment right now. All right, let's get to the show. First of all, we always start the show with talking about what's the most important event of the week. And when we bring a guest on, well, Karen, you're here. We just wanted to ask you, what's on your mind? What's really interesting for you in terms of what's going on in the markets today?
Well, I think what's on a lot of people's minds, especially on Twitter, is the Fed's pivot. Specifically, they've gone from hiking and reducing the balance sheet to, staying put overnight, essentially. And this has come as a shock to a lot of people, especially because the S&P is at 2,800. Everybody sort of expected that the Fed would, turn more hawkish now that the stocks were higher, but we've actually seen the opposite. And, part of my belief behind that actually is that it's very geopolitical in which, the Fed is acting. It's not economic per se.
Okay, so in what way? So geopolitics, is this Russia, China? What part do you think, and why is the Fed pivoting so hard?
I think part of it is because, I think the Fed over-tightened in the first place to sort of bring China to heel last year. I mean, I think a lot of people recognized during the year that they shouldn't have been tightening, by reducing the balance sheet and hiking interest rates, sort of on autopilot, right? That's what Powell said, right? Up until December, pretty much in December of last year, he was talking about that. And, and it seemed like not a lot of progress was being made, between the U.S. and China on the agreement until quite recently. And so I take the recent shift as sort of evidence, one of many pieces of evidence that the U.S. and China are coming to a larger agreement, which, our president obviously talks about a lot. And, maybe he's sort of getting ahead of himself at times, but I think that's definitely in the cards now at this point, especially given a lot of recent actions that have come from both the U.S. and China of late. And we can talk about that if you guys want.
So, so to some extent, I guess I first heard this theory when Mark Hart started talking about it, and his argument was that that the Fed was going to go dovish as basically an agreement that was made by Mnuchin and Lighthizer in terms of, and I guess that would kind of dovetail into your idea that the Fed was going hard and kind of tightening the screws and causing the most pain to China, combined with the fact that we had the tariffs. And it wasn't until they started crying uncle and was willing to negotiate that the Fed actually came in and started to be more conciliatory. Is that the gist of your argument?
Yeah, that's. I mean, I should full disclosure. I talk with Worthray quite a bit on Twitter and sometimes on the phone, and so we share ideas. And yeah, I mean, our thinking is quite aligned in that regards. I mean, a lot of it is due to the fact that the U.S. has sort of realized that the current status quo favors China a lot more than it favors the U.S. right now. And so Trump has been, his number one job since he's been in office is to renegotiate the status quo with pretty much everybody. And it started, first with NAFTA, which, a lot of people have sort of noted didn't really change that much, but it did make certain changes towards one particular entity, which is China, right? Anybody that's dealing with a non-market economy or of the Canada, U.S., and Mexico, they have to tell the other members, and there's certain other implications there that sort of limit China's ability to get around sort of tariffs or whatnot.
For sure, Kieran. In terms of as a Canadian, we immediately recognize that what Trump had negotiated, or more so, I guess it was Lighthizer, or was it the other guy? I can't remember. But regardless, we realized very quickly that we got played something fierce, because we are no longer able to go and negotiate deals directly with China without having to go check with our big brother to the south now.
Yes, exactly.
And that was actually a huge kind of concession that we made. And if you think about it, it's in essence forced us, and we see it with the what's the lady from the 5G network? What's that? What's the name of that firm? Huawei. How we've had to go and we've arrested her, and we're in a lot of trouble as Canadians with China. And I guess as a Canadian, I have a little bit of problems because we're getting beat up pretty bad by China, and our big brothers to the south aren't sticking up for us nearly as much as they used to. Because if you look at it, between the Huawei kind of fallout, we're actually no longer able to sell our canola and all these things. And it's like China's taking it out on us because they can't take it out on you guys.
Yeah, and I mean and that's part of the game, right? And China's playing it as well as they can in those regards, right? They're picking off sort of the weaker links where they can, and they're really punishing you guys in particular, right? And they're doing it to Australia as well. I think they've hurt Australia's imports for iron ore greatly recently. And there's what China is showing you though is that they're a real player now. That, as Worth Ray and Mark Hart like to say, it's a G2 world, right? And China is actually like a legitimate rival to the U.S. And these sort of maneuvers are now out of Trump and his administration, and now I think the Fed, is that they're maneuvers that of recognition that China is now a rival of almost equal power, right? And so using that, you can see a lot of actions that stem from that, and they start to make more sense, I think, in terms of where the world is going and sort of what U.S. policy is going to be and how that might affect sort of the markets overall.
And so what do you think is the kind of implications from a market point of view in terms of this kind of change in atmosphere or environment that we've experienced over the last kind of 3 months with the Fed shift and with China being forced to come to the table a little bit?
You're right.
What are the investment decisions that you or kind of changes that you want? What are you watching in terms of for the markets on that side?
Well, I think the biggest thing obviously would be the dollar. And sort of what the direction of that has been, right? And I think markets have been whipsawed since the dollar really hasn't gone anywhere since the midway through Q4, right? We've just been going up, 2 or 3%, then down 2 or 3%, and it's just been this sideways chop that's sort of just been grinding everybody up. And right now, I think most investors are sort of overly bearish the euro right now versus the dollar. Maybe that's the right decision. But the real implication and what the U.S. is trying to do is we need to close our deficit with China. And the only way you can do that, you can't, no amount of tariffs is going to change, that. You're going to actually have to fundamentally alter the value of the currencies. And so you're going to have to revalue China's yuan if you want to close the deficit. But the question is, does China actually want that? Can they do that? Is that, what's the mechanism of how that happens? And some of those things aren't entirely clear to me right now. I mean, it's very complicated with China having a closed capital account, having a massive housing bubble that which prevents them from opening up the capital account, right? If any Chinese person could take their money out, they would just sell. They could sell their real estate, and real estate would drop, and the capital could leave, right? And that's a real concern for the Chinese people, right?
One interesting theory that I heard on this was when we had Russell Napier on Macro Voices, he floated the idea that even as potentially as early as this year, that I guess it's a speculation that China would eventually be forced to actually float their currency, and to me, that in itself, at least in my mind, makes a lot of sense, because ultimately that's the market finding equilibrium. It's when you're trying to force a specific currency level, the PBOC has to step in there and be the buyer or seller to maintain the peg. And that keeps, then you have to put capital controls and all of these other variables in there to try to manage the money flow from one country to the other. But when you leave a floating currency system, it's where the currency finds the equilibrium to bring everything back in check. What do you think of that?
1 second.
I mean,
1 second. So I'm going to jump in there, Kevin. It's Kevin, by the way, Patrick. I just want to say one thing. The trouble about that is that, as Kieran mentioned, if they float it, there might be more Chinese trying to get their money out, which would actually cause the value of the yuan to decrease, which would be the exact opposite of what Trump and company want.
What they want, though, what the point Russell Napier was trying to make is because of the situation in China, the only way they can deal with their situation is actually a cheaper currency, which is completely the opposite of obviously what both of you are suggesting, which is that the U.S. dollar has to be somewhere maintained in this all of it. But it's going to be really interesting to see whether or not it plays out this way, isn't it?
Yes.
So Kieran, I'll let you talk there.
Yeah, I totally agree. I mean, on the surface, that is how, it seems impossible, right? Somehow you need to create, it's a supply and demand issue. You have to create more demand, that comes into China than that would ordinarily leave, right? In the case of a float. And I don't know, I don't think it could ever be legitimately a completely free float, at least for the next 10 years. I don't think that's in the cards right now. I think it's more of a China will start letting, U.S. corporations, foreign corporations actually take capital out if they wanted to. That would probably be the first opening up, because right now, obviously, corporations are quite limited. You make profits in China, those can't come home, right? And that's a real big problem for a lot of corporations, right? And so maybe China can somehow make a way where they're able to, with the U.S.'s help, and I think more recently what we've seen in Europe, for example, right, where Italy, which is the first G7 nation to sign up for China's One Belt, One Road program. They did that, I think, last week or earlier this month, and that's caused a big stir. And even the current finance minister or foreign minister said that the U.S. should mind its own business because we owe China $1 trillion or something. So they were really, they didn't want to take any smack from the U.S. And then, you have Angela Merkel talking about reforming the World Bank and the IMF and a few other, major institutions. On top of this, Macron earlier this week had this ridiculous statement, after, meeting with Xi, saying that with China, they're going to make the planet great again, and that he was angry at Trump for pulling out of the Paris Climate Accord. But what I'm saying is you're seeing a shift in Europe, this European shift more to the east. And, Europe has a decent amount of savings, at least in Germany, where, they could conceivably start to convert their savings either in dollars or in euros into yuan, right? Germany does not want a strong euro. So how can they counterbalance that? Well, they can just buy yuan. They can buy RMB denominated bonds and have China use their excess capacity to build out Southern Europe. I mean, I'm not saying it's a smart idea for Europe, but that's sort of the idea of where they're going and how they could help prop up the yuan by shifting their savings essentially and trading in yuan with China to build various things. And so once again, this all sort of goes back to can the rest of the world bring in demand to bring in yuan demand to counteract any demand that may come out of supply that may come out of China, sellers, essentially people selling their domestic renminbi and getting out. And that's sort of the biggest question of whether or not it's possible or not. And you obviously would need the Fed for this to start going more dovish, right? You can't have the Fed hiking interest rates and tapering, and reducing the balance sheet, right? That would sort of just throw a wrench in the whole program. And I would just say, sort of, and I know I'm rambling a little bit here, but in terms of these whole spheres of influence that are forming, right, and by sort of how Europe is shifting east, you're seeing America shift more and focused on the Western Hemisphere only. This is very specific here, right? How the U.S. has really started to focus down on Venezuela, and actually Bolton, which is the National Security Advisor, I think that's his role. John Bolton recently put out a statement saying that against how Russia landed troops in Venezuela, and he specifically said no, any non-Western Hemisphere power should stay the hell out of the Western Hemisphere, saying this is our neighborhood, this is our sphere of influence. We're going to focus on this for now, and you guys can deal with the rest of the world. Because obviously nowadays, the U.S. has shale. We don't need to worry as much about what goes on in the Middle East anymore, except for maybe trying to muddle with China's own energy security. That's pretty much it. And I'll sort of, I'll stop the rant there for now and let you go.
No, it's Kieran. It's great. So actually, I have a question for you in terms of. I'm sure you're familiar with Peter Zeihan. Is that how I say his last name?
Yeah.
The geopolitics analyst that argues that the days of America being the world's policeman are over. I'm wondering, do you have any feelings about that? Like, do you foresee a point? Is this the beginning of a new era that, like he believes, where we're no longer going to see America worrying about the Chinese South Sea or whatever it is, and going around and making sure that they're the policemen for the world?
Yeah, I think that's a really good point of his, and it's definitely heading in that direction. Especially if you mentioned the South China Sea, where arguably China is at par, if not stronger than us, in that one specific region. Now that they have, sort of certain weapons, and they've built out sort of essentially aircraft carriers on these islands, stationary aircraft carriers, right? And so, it's not like the U.S., if China wanted to, they could conceivably in a few years take Taiwan, and, the U.S. couldn't do anything about it. And I think that's sort of where we're headed, simply because we don't really have a dog in the fight anymore. You see the U.S.'s relationship with Europe and Europe's desire, to partner with China more, and specifically, look at Huawei and the 5G technology that they're offering Europe, right? They're essentially it's on par with the U.S., if not better, and China's willing to subsidize it and give you, half off or something, right? So Europe's looking at this deal and is like, wow, let's do this. It's way better, right? And so I have to agree. You sort of, I think Peter Zeihan says specifically, this is the U.S. Simply has no dog in the fight anymore. But we do have bases around the world. We still have the largest military, the largest navy. So it's not like we're going away. It's not like we're not going to keep that upkeep. But I think over time, at least relative to China, it's going to that advantage is definitely going to dwindle.
Okay, so I'll ask you to finish up with one last thought about China. There's a famous Texan hedge fund manager who thinks it's going to collapse in a fiery mess because of all the credit. Do you share his view?
Kyle Bass? Sorry, maybe you shouldn't name him.
It's all right, no problem. I'm sure Kyle, if you're listening, we love you, bud.
I think. Look, on the economics, it makes sense, but it's China, right? It's sort of one of those geopolitical, the geopolitical forces are clearly, I think, aligned against this outcome for now. And China clearly, who knows how they pull this off, how they keep it going, but they continue to do so. And everybody's lost a lot of hair and a lot of money trying to bet against them. And, it's just something I'm not interested in doing right now, and especially because of my geopolitical views right now. Maybe that changes. Maybe, the swine flu gets out of control and China, seizes Taiwan as a way to get back at the U.S. because their economy's imploding. Things can get really dark if, really fast if China's real estate bubble blows up. It's sort of like, what did Hugh Henry say, right? If China's economy collapsed, you jump out the window, right? Like, I mean, it's sort of that one kind of event, like the world's over if that happens.
Yeah, but don't worry about Hugh because he'll be in his St. Bart's house, and it's the first story. It's a bungalow. Okay. Well, listen, at this point, we're going to kind of go on to the next segment, which is our Tales from the Trading Desk. And, I'm not sure everyone's aware, but Kieran is a little bit of a millennial. He's way younger than he sounds, and he's done more in his, what are you, like 21, Kieran? Like you're awfully young.
I wish.
Yeah.
I was
So,
young.
but he is definitely a young guy. But he actually has some stories because he's grown up in a family that's been exposed to the markets for a while. And I just kind of found it fascinating your kind of familial connection. And I was wondering if you could share it with us and maybe share some stories about growing up in that house.
Sure. Right. And so my grandfather was Leonard Baum, and he was, he had a long life, and he did a lot of great things. And one of the things that he probably is most well known for, or would be well known for, is he worked with Jim Simons at Renaissance. He was the second guy Jim hired. Jim fired the first guy because he lost the money. And they were they really, before they started Renaissance, they actually started just trading the markets in a little office space on right off the campus of Stony Brook. It's actually right outside the train station. Obviously, it's not there anymore, but I think it's become a Dunkin' Donuts now or something. But yeah, so I mean, my grandfather went straight from the government to trading for Jim Simons, who Jim Simons hired him to actually write models back in the 70s to trade currencies and whatnot. Models that my grandfather developed for, I guess I should add this part. Jim Simons and my grandfather worked at IDA together, which is the Institute for Defense Analysis, and they were essentially code breakers. So my grandfather had to develop code and programs and algorithms to sort of crack Russian code during the Cold War. And so they
wow.
And so Jim Simons hired my grandfather to use his algorithm, which is actually a pretty famous algorithm. It's called the Baum-Welch algorithm, and it's sort of it's one of the foundations of sort of natural language processing that we use today, and sort of Google search algorithms and stuff like that. So he developed some of the foundational mathematics for that, which is pretty cool. And so Jim Simons recognized the potency of this, and he's like, why don't you come work for me and do some modeling? And my grandfather got there, and he did not want to model anymore. He looked at the markets, and he's like, I just want to trade. And he just started, he just came in one day and just told Jim Simons to find somebody else to do the models. And he went on and traded. And he was actually very good at that, despite he never, ever did anything like that at all in his day. And so some of his stories are pretty good, and I'll try and see if I can share any, really remarkable ones. He had a weird philosophy that he developed after a while, which was sort of, his whole strategy was just buy low, and he would never sell until somebody, probably Jim Simons, told him to sell. And obviously doing this in the late 70s and actually into the early 80s was a really good idea. Obviously that's the best buying opportunity of all time. And so I guess, let's see, in 2009, which is, when you had sort of one of the greatest buying opportunities of all time, he saw the markets crashing down all around him. And I think, this was, maybe it was in 2008. I'm trying to remember exactly, but he saw Citibank. Citibank was, it was a great stock during his day. And so what does he do? He starts buying it, it was down at $2. Well, it goes through $2, and he's like, okay, he keeps buying. And then he puts a big order in at $1, and then he's just telling me how he held the market there for, I don't know, like an hour. He was just watching. My grandfather, by the way, is legally blind, so he's watching CNBC with his face pressed up against the screen. He had macular degeneration, so he had no, I think, rods in his eyes. And he's just watching the ticker go, and he's watching his order just hold the market at 1. And then it went through, for I think like a few minutes before bouncing, and that was the low. And he held those shares until his death in 2017, actually, which was,
wow,
one of the most impressive things.
So he bought the low by 1 penny and bought it in size while he was
held it.
Wow, unbelievable. That is a terrific story, Kieran. Actually, while you were saying, talking about your grandfather and the fact that he decided that coming up with the math wasn't nearly as exciting as doing the trading, I went and found this Jim Simons quote that I thought is hilarious. He says, "One can predict the course of a comet more easily than one can predict the course of Citigroup stock. The attractiveness, of course, is that you can make more money successfully predicting a stock than you can a comet." I actually wonder, given that was in January 2008, I wonder if that was about your dad or your grandfather. Sorry.
Yeah, well, I think that was obviously before the crash, January 2008, right?
Yeah, that's right. So he had a predictive
timing,
ability.
Yeah, that's a real.
Okay, so listen, we're gonna for those that are interested, make sure you stick around because Kieran's gonna join us for the after hours, and we're gonna talk a lot more things, including the fact that he is a former elite world-ranked video game player. But in the meantime, why don't people tell us? Why don't you tell us, Kieran, where people can kind of learn more about you or follow you or whatever you want? Do your plug. Go ahead, sir.
Sure. Well, you can. I mean, my only exposure is on Twitter, and you can find me at Clendathu Cap. At Clendathu Cap. And so, yeah, that's it. Sorry, I don't really have much more than that. I had a blog, but I don't blog anymore, unfortunately.
What's Clendathu? That's your company?
Oh no.
What's the name?
No,
Here it comes.
The name of my blog. I started back in I think 2013, just to sort of help me understand the markets and write out my thoughts. I think that's really good for young people that want to get interested in the markets. Write your ideas out. One, it'll get you better at writing. Two, you'll realize how bad you are, and it'll just help you be honest. And so I mean
that's right. But isn't Clendathu some game or video game? Isn't it something like that? Am I wrong?
It's based on a movie, or actually it was a book first.
Oh, there we go.
Yeah, Starship Troopers was the book that became a movie.
Yeah.
And then
right.
Clendathu was the alien.
Oh, I actually remember that movie. I liked it back in the day.
Yeah, I still do.
Whoa, Patrick, you've just insulted him by saying it's like something back in the day. Okay, so stick around, everyone. You got to learn more because there's going to be a lot more great stories from Kieran. So stick around. Thanks for joining us, Kieran.
Sure.
All right, joining us here is Ari Pine, who wrote a great piece way back on spoofing, and we thought it was a great opportunity to bring him on the show to kind of start this conversation. And, first of all, Ari, welcome to the show.
Thank you very much. Really flattered to be included.
Well, thank you, and it's great to have you on. And thanks for taking the time and joining us. What got Kevin and myself really interested in having a chat with you is really your outside the box thinking. Is the idea that what could go wrong from rules being implemented on spoofing. But before we get into that, why don't you just take an opportunity to explain to our listeners what spoofing is in the first place?
Yeah, sure. That's probably a good place to start. So spoofing is when essentially it's like bluffing in poker. You're trying to show direction in the market by offering a large volume of futures or stock in an effort to buy a small amount, or showing a large bid in order to sell a small amount. And once you get filled on your small amount on the opposite side of your large order, then you cancel that order. And then the idea being that the spoofer will have purchased at an attractive price and it will go up, or vice versa. Does that make sense?
Oh, absolutely.
Yeah, no, for sure. So there's a famous trader. Oh, hi, Ari. It's Kevin. So there was a famous trader that was the London-based trader, the guy in his pajamas that was living in his parents' house trading. That's right. And why don't you just tell us a little bit about him, because I think most people will kind of know that story a little bit, and what he was doing and what it contributed to the flash crash.
Well, I won't claim to be tight with Mr. Sorrell, but my understanding of what he was doing was actually, of all things, if you read the description, it actually seemed as though he was spoofing from the buy side during the crash. During that flash crash, and apparently somewhat successfully. That's what my understanding of what he was doing during the flash crash was. More generally, he had contracted with a software vendor in order to automate his spoofing, which then actually ended up causing trouble for the vendor, who is now currently going through the courts right now trying to get his case dismissed.
So do you know who the vendor is?
Yeah, it was Jitesh Fakar. And apologies to Jitesh. I've met him before. He's out of Chicago and ran a group called Edge Tech. I believe it was called Edge Technology.
Oh, I see. And then he's in court now about this. So let's just kind of think about this like from a trader's point of view. what they were in essence doing was trying to bully the market by putting orders on one side that were larger than they really wanted to execute, in the hopes of moving the price that direction so they could actually execute, like be filled on the other side of the order. Is that correct?
Yes, that's exactly correct. Actually, I really like your term of bullying the market. That's exactly right.
Right. So, and I guess to some extent, it's kind of surprising, that this is illegal. And I just want to point something out before we go any further. This is illegal, and if you do this, you put in orders that you have no intention of getting filled, you will get kind of fined, or even worse, go to jail, like this London-based trader. So by no means are you, unless like from your article, you very clearly point out that this is illegal and you shouldn't do it. But you had kind of an interesting take in terms of what the consequences of an exchange, or kind of a regulatory body enforcing this practice, does to the market. Why don't you tell us a little bit about kind of the implications if nobody is allowed to bluff the market?
Right. So, so first of all, not only do I think it's worthwhile to emphasize, just as you did, that it is illegal to do so, but it's also worth noting that every order, right? So if you're a spoofer, you normally are looking to trade 5 lots, but you throw up sell 300 at a certain price in order to buy your 5 lot. You're on the hook for that 300 lots. So
right.
It's worth noting these are live orders. You have to have the credit lines in place with your futures broker or your equity broker in order to place these trades in the first place. So it's worth noting these are live trades. And another thing that's worth noting is that although the spoofer puts up, let's say, offers 300 trades at 66.72 to buy a few lots at 66.71, they're not filling their own order. What is actually occurring is somebody else, another trader that's looking at the market, sees, hey, there's selling interest at 300. Let me get ahead of that order. And I'm going to go sell the 66.71s, which is exactly what the spoofer wanted them to do. So it's worth noting that the spoofer is not actually transacting. They are on the other end of the order, and you can look at those traders that are hitting the spoofer's bid as being trying to front run that perceived 300 lot order. And that's exactly
so it's kind of right. It's kind of hilarious that the people that were actually complaining about the spoofers were kind of high frequency guys in themselves, right? Like I think I saw, wasn't Citadel one of the complainants about this kind of practice?
Not only is it, of course, ironic that, yes, it was Citadel and a couple of others, but it's amazing how blatant they were in what their complaint was, which was to say that they were having trouble figuring out which way the market was going.
the nerve of them. It's kind of like a man bites dog situation.
Yeah, and so clearly there's a number of questions that raises in and of itself, but it is rather humorous if it wasn't bad for the market. So going back to your other question, what is the expectation if you ban bluffing? Well, and what I brought up in the article was, imagine if you were at the poker table and you were part of a group and you're normally used to bluffing, but you're a straight shooter. You just bet based on what your hand is. You don't pay attention to what other people are doing, so you don't really care whether they're bluffing or not. Well, great, you're a straight shooter. Well, if you all of a sudden know that bluffing is absolutely not allowed at this table, that has to change your entire outlook on how you bet, because all of a sudden the betting from people has exact information content. You know that they're only allowed to bet according to what they think the probability of their hand from a strict mathematical perspective is. And the same thing goes in the market now, because whereas before you weren't sure whether the orders in the order book were real or spoofing, now you know that the orders in the book are real. So as a consequence, if you are what we would say, right, when you were on the desk before, right, the real money orders aren't going to feel comfortable placing their orders in the order book because they know that they're going to be exposed in the same way, right, that the tide goes out and you can see all the fish. So
Yeah, so in essence, they made it so that it's even easier for the HFTs to pick off the real orders, right? Like that's in essence what they're saying. They're making the market, and the consequence of making it so that only real orders can be placed means that
real orders
that
can't
those
be
real
placed.
orders, right, will try to hide them more by going to other venues, right?
Yeah, so which is natural. You can't really blame them. So then they want to go to a dark venue, but this ends up if volume goes to what dark venues rather than being lit, it's very bad for retail orders because those one lots aren't really going to be there. All of the liquidity is going to be elsewhere. And that was really one of the nice benefits of having these electronic markets is that you were able to go and trade your one or two lots the same way that anybody trading treasury notes from me doing a one lot to Goldman Sachs trading thousands at a clip.
Right. So, Ari, I'll tell you a story. I used to sit on the desk at a Canadian bank, and when I used to trade, we used to stick fairly large orders in the machine. Like when we trade predominantly equity, so I would go and trade tens and 20,000s without blinking. And in fact, when there was liquidity, I would be happy to swap like 100,000s with people. I've come back now to the buy side and have been kind of trading in the market. And every time I go with the 10,000 lot order, it just, I get everyone disappears or either front runs me and there's nobody to trade with. It's like the market is being ruined. Like, I just think it's terrible. Like it's just like it's nothing like what we used to have. So I have some ideas about how to fix it or what might be done to change this. Do you have any?
First of all, obviously, from my perspective, I think spoofing ought to be allowed. It's not a strategy that I've ever done because it essentially is selling small options, and I tend to identify more with long option or long convexity positions, right? Because if you think about it, putting a 300 lot on the screen, you can get lifted, right? If you're a smart guy and you go, hey, I'm looking for the spoofer, that's an opportunity for me to get in at a good price. Then you can get taken advantage of, and you can. That's why sometimes you'll see back in the day, the prices will go very quickly when an order went, is because people got caught offside on situations like this. I would think another way of going about it is so one of the trends that I've also seen in addition to the spoofing is that the exchanges, and I think primarily because they've been converted to a for-profit mechanism, is that they've really focused on their highest volume clients. And so they provide discounts and so on, which is really understandable. I mean, why shouldn't they be able to provide high volume discounts to their best clients? And so it appears to make sense. But what happens is it becomes very uneconomic for smaller traders that might be providing some of this little back and forth in the meantime to become active. So it's very expensive in terms of data fees. They're not getting rebates on their contracts in the same way that you would if you are, a Citadel or a DRW or whatever, where these guys are big and obviously very profitable customers. So it seems to make sense on the surface, but from a regulator standpoint of wanting to have a broad base of differentiated participants in the market, it's been harder to do.
Yeah. So I agree. couple of thoughts spring to mind for me. First of all, I agree with you that the real problem with spoofing is the fact that guys are going and putting orders that are risking the integrity of the system because they're much bigger than the equity in their account. So one of the big things that I kind of pushed back on was this guy was trading a 300 lots, this London-based trader. Did he actually have the margin in his account to trade that many contracts? And if he did, I kind of think he should be allowed to put in whatever orders he wants to put in, and that shouldn't ever stop him. But if he only had $20,000 and was offering this 300 lot to try to get it, like that's my kind of worry, is that it ends up being a risk to the clearinghouse mechanism, because at the margin, what if he does it with a 2,000 lot or a 5,000 lot, and it gets more and more scary that way. But the other part that it's such a simple solution, is that just make the orders have to stay in the book for like a second or 2 seconds. Realistically, everyone that puts in an order should be willing to stand still for a second. And if we do that, it'll change this kind of idea about it'll change the whole game. And I don't understand why more people don't just come around to this idea that we just make it a random kind of point. Like maybe it's like anywhere from 10 milliseconds all the way up to a full second, so that you never know how long you're in there. And you take out this whole kind of ability to know exactly where you're at, and introduce some kind of randomness, so that the people that aren't that are just not really adding any value, but merely front running and kind of taking advantage of it, are no longer the ones that are able to do that. What do you think about that solution?
So part of my background has been as a bit of a spread trader, doing some quantitative analysis and putting trades on. And one of the things that you do is, I might trade contract A, but I'm trading it against contract B. So my bid for contract A is dependent on B. So a lot of times I would be putting orders that are either spaced, away in some way. And so I would it's not so much that I would cancel after a certain amount of time, but it would be dependent on something going on in a different market. So I'm not sure what you're saying makes a ton of sense to me. I don't know how you would address the fact that there's a significant portion of traders out there that are doing contingent orders, where, you may want to trade either a calendar spread, by legging it, or you're trading gold in one market versus another, or trading a spread between a couple different metals or so on, or something like that. So I don't know how that might work, but maybe you can break it up into auctions that are spaced apart.
Oh yeah, that's true. What's funny, Ari, is that in my old previous life, I also did a lot of that kind of arbitrage between two markets, and so we were one of the first to do interlisted arb versus the Toronto Stock Exchange versus the New York Stock Exchange, and it was before the Americans had kind of figured it out and driven the spreads to zero. And it was actually we automated the process, and this is in the 90s, and it was a terrific business and stuff, but for a long time, it just the fills were such that it would take like seconds, and you wouldn't know if the exchange was going to be busy at certain points and stuff. And it's kind of just shocking to me that the precision that now people are trading on, and the kind of what used to be kind of something like a certain amount of risk that I was willing to take is now become like. It's kind of shocking to me that people are talking in microseconds when I was talking 2-3 seconds seemed something that was perfectly acceptable for waiting for a fill. So it's in another league, and it's just I just find it kind of shocking to me, though, that we're sitting there getting mad at people for going and putting in these orders into the exchange, that the spoofing, and meanwhile the HFT guys aren't really adding as much. Not that the guys doing the spoofing are adding a ton of value, but at the same time, it's the pot calling, the the kettle black to me. It just seems completely and utterly wrong. And if you want to put in an order, as long as you're willing to get filled, you should be allowed to put the order in. I just feel strongly about that. And to some extent, I think that the market would figure it out. So if he's putting in an order that is not real, then that's in essence an opportunity for size to buy an offering that's not real. Like, so like, I don't get why people don't say, well, he's exposing himself. There's a weakness there. I'm going to buy it.
Absolutely. I don't know how, I don't know whether, if you're, say, a big player in the market that, maybe run a screen on what the typical, size is, and, there's something that's outsized there, and, whether there's a way to statistically tease out a spoofer versus, a real order,
right,
or something along those lines. And actually, that exact question is exactly that gets at the heart of why we ought to have the spoofers there, which is to say, it provides, it forces uncertainty in decision making. And so what happens is that people just really don't know, and because they don't know, you have to respect that a little bit. And so respecting uncertainty is part of trading. And I think it's also really worth reiterating that all of these arguments that we're talking about are all dependent on what I think is a very true statement, which is these are live orders. And secondly, although you can't guarantee this because each clearing firm may, be different in terms of what their credit assessment is, but presumably these clearing firms are only allowing an extension of credit to the extent that the spoofer, meaning that their customer, can afford.
Right. So it's assuming that, then you kind of have to argue that they should be allowing them to do the trades. But anyways, Ari, I really appreciate you coming on and spending some time with us. Why don't you tell us a little bit about?
Yeah, actually, before we do that, I just want to show here for our listeners and watchers here, if you want to get the article that Ari wrote about this, if you go to the medium.com, you just Google medium.com, and then just the name of the articles, everything you thought you knew about spoofing is wrong. So, and you could type in Ari Pine's name in the Google, and I'm sure the article will come up, and you can read a really amazing article he wrote back then, and just explains everything in there. So you can find that there. But as well, like Kevin, like you were saying, Ari, if you want to just let all of our listeners know where they can follow you and where they can learn more about this stuff.
Yeah, I'm on Twitter. I'm belying my option background. At Standard Dev on Twitter, and I believe it's STD_DEV. And I'm sure you can look up Ari Pine on there as well. And then we have an entire blog from Digital Gamma, which is my current company, and we put out a few articles every so often talking about various things.
Well, that's terrific. Well, thank you very much for making time for us, Ari. I really appreciate it.
Thank you. I'm really honored to be a guest after listening to so much. Thanks.
Thanks again.
Right,
Take care, Ari. Okay, so Patrick, this week in trading history, we go back to Ben Bernanke and one of his famous speeches. Why don't you just take it away, bud? Tell us all about it.
Well, it's a famous speech. It's probably the most famous speech in terms of going back to something that was said. So here I've got the Board of Governors, Federal Reserve System, testimonies, all of the different pre-scheduled statements, and it was back on March 28th of 2007. When Ben Bernanke testifying in front of Congress, and he makes the famous statement, right? And let me
what was that? What did he say, Patrick?
Well, what I've got here, if I'm going to find it, hold on a second. So So it goes, although the turmoil in the subprime mortgage market has created severe financial problems for many individuals and families, the implications of these developments for the housing market as a whole are less clear. The ongoing tightening of lending standards, although an appropriate market response, will reduce somewhat the effective demand for housing, and foreclosure properties will add to the inventories of unsold homes. At this juncture, however, the impact on the broader economy and the financial markets of the problem in the subprime market seems likely to be contained.
There you go. Bingo. You got it. The subprime market is contained.
Subprime crisis isn't contained. In fairness, when Ben Bernanke said this, it was March 28th of 2007. The market did proceed because in the prior month, the stock market had like a 10% downdraft when the initial shock of some of the initial subprime stuff started coming out. The market did proceed over the next 4 months after March up until June, July to actually rally 10%. So Ben Bernanke said this, and the market continued higher. Reminiscent a lot of bulls such as yourself getting all caught up in Powell's panties. But the market proceeded to rise.
Come on, that was funny, man. I like that.
And then, of course, it started roughly in June, but it was really the event in June, July in 2007 when Bear Stearns had to stave off the collapse of 2 of its hedge funds in the subprime space that were basically being zeroed out. They had no market on the subprime shit that they were leveraged on. And that really marked, in my mind, the true beginning of the liquidity crisis. That's where all the TED spreads were blowing out. All the money markets started to break down. And even though the market proceeded to retest those highs, if not made it a little higher high in October, that really did mark the turning point in the bull market. But it was that statement that it was contained that was really one of the more interesting statements that Bernanke is so well known for.
Right. So listen, Patrick, I put together some statements. I don't really think it's that bad, and I put together some statements that maybe will give Bernanke some solace when he's thinking about this. And I thought you might be interested. I'll go through them with you here. This is by Thomas Watson, chairman of IBM in 1943. He says, "I think there is a world market for maybe 5 computers." And then here. Decca Record Company, when they passed on the Beatles in 1962, said, "We don't like their sound and guitar music is on the way out." And here's one of my favorite ones. United Artists, movie company, says something about, after rejecting Reagan as the lead in the 1964 film The Best Man, he says, "Reagan doesn't have that presidential look." Okay, so I thought that one was good. Here we go. Let's see what else we got here. Let's just see. There's more here. Oh, this is one of my favorites. Very topical today for Boeing. This is a Boeing engineer after the first flight of their 247, a twin-engine plane that holds 10 people. They said there will never be a bigger plane built. 10 people. So, history is filled with stupid shit like this that Bernanke said. And to be fair to Bernanke, he's got to say that. He's the chairman of the Federal Reserve. What's he supposed to do? He's supposed to say, God, watch out, the world's coming to an end. He has to come up there and say positive things. But that doesn't stop us from making fun of him. Because,
I've always said this, even in my master's courses that I teach at Big Picture Trading, I always say those people in positions of power, they can't say what the truth really is. They have to say what people need to hear.
That's right. What is it, Junker, that says when the going gets really serious, you got to lie?
Yeah.
Like I think Junker said that, but the reality is when the going gets really serious, he has to have another drink. But because that guy is like guy, maybe he has to have another drink and then also lie. Yeah, they have to at the very least put the most positive spin they
Glass
can
half
on
full.
it.
Glass half full.
So
because listen, can you imagine the statement was said otherwise? That the subprime is probably going to create a crisis and shit's about to hit the fan. Can you imagine he said that?
Battle your hatches. Get ready for the stuff to really hit the window. Get ready, boys.
But this is why I kind of laugh when everybody hangs on the Fed statements. The key is not to listen to what they say, but what they do and how the market is moving forward. Like you have to go beyond the words, because the words are just a scripted thing that has always got a bias as to what we need the market to believe or what they need to hear. That's not really the truth.
Yeah, no, you're absolutely right. But that doesn't stop us from making fun of them. So, anyways, that's a great This Week in Tales, This Week in History.
It's one of Bernanke's famous moments, right?
Yeah,
and
you're absolutely correct. And it was this week, way back when, that it happened. And it's one for the history books. It'll be on his tombstone. This was contained.
All right. So let's move on to WTF Clip of the Week. By far, one of the favorites for our listeners. And what do you have in store for us, Kev?
Well, I saw Professor Siegel talking about the China-U.S. negotiations. And, for a guy that claims to be a long-term investor, he seemed pretty familiar with our different, technical patterns. And I thought it was pretty interesting what he suggested you should do on the announcement of China-U.S. trade deal. So without further ado, let's play it.
Let's play it.
When they raised the funds rate to 240, the 10-year was at 3.25, and everyone thought it was going up. I think if they had known, the fact that the 10-year dropped to 240 is a game changer. Had they known back then that the long bond would be at 240, I don't think they would have raised in December. It makes no sense for the Fed funds rate to be exactly the same as the 10-year bond.
Life here is all about keeping tabs on your neighbor and an eye out for intruders.
I think the Fed made a policy mistake in December, and now it's going to be harder to unwind it now.
Well, they can unwind it. I don't think,
But you do. But
40
you said
basis
yes.
points on the short end is fatal, but I think it's a.
You think they did make a mistake?
I thought they made a mistake of raising it, and then they made a terrible mistake in the statement that came out that sort of implied they were going to keep on raising it in 2019, which they walked back immediately when the markets collapsed.
And bark out distinct calls to identify different predators.
I'm not talking about a big break in the market, because if the long bond's at 240, again, where do you go? But let me tell you, some people said, I'm going to cash, 240.
And give a be on the lookout call. These animals actually have extensive vocabularies for different predators. Four-legged, winged, slithering, and degrees of danger.
But are you saying that the gains are in for the year at best?
I think we're maybe up 5% the rest of the year. Most of the gains are in. Maybe a slight upward tilt. I think the market's staying up because I think everyone expects no one wants to be short when Trump announces a deal with China.
After the fox is gone, a very strange thing happens.
Professor, I'm confused by what you just said. You said at one point that the China deal is all in the market, but then you said it could move up
about
5 to
80%,
7%.
80, 90.
Okay, got it.
And it will pop.
A hopping yip fest among the prairie dogs.
It will pop. We're going to get a 5, 6, 7% move if he says we made a settlement.
I agree. But
You know, I don't want to be short through that episode.
No, but you're also suggesting
let's forget about earnings.
You're suggesting that you would fade the pop that you would get from a trade deal because that would be the final part of the puzzle.
I would sell the pop.
Is this a crazy kind of survivor's guilt? A celebration that they're still alive? Or a big thank you sent up to the prairie dog gods?
I would say if I'm a short-term trader, I'd sell the pop on the trade move, in my opinion. And you're going to get a pop. I may be wrong on that. You know, as you know, I'm usually an advocate for long-run investing, but you know, everyone's interested in the short run. I think that might be a trade on that pop.
Recent research suggests that it's a test of their emergency broadcast system. Maybe theirs needs a tune-up.
So,
oh my God,
who knew
Kevin,
Professor Siegel knew about the prairie dog formation?
You know what? I think that he did an academic piece on this recently.
Right.
I think it's going to be up for a Nobel Prize.
It's
at
a
some
dissertation by a PhD student.
Yeah.
The prairie
Sell
dog
the pop!
formation.
Sell the pop.
I know. It's just like I just was laughing
For
myself.
our listeners that didn't see it, I just jumped out of my seat when I said that.
That's right. What is he doing? Like, this guy is, I don't know. He's a little bit of a nutcase. Like, he makes me look like a nice, calm individual. Like, he's all over the map. He's sitting there telling you to sell the pop, but then at the same, in the next breath, trying to tell you how he doesn't, condone short-term trading. You know what? It is interesting, though. When I see university professors telling me on Network Financial News that you should sell the pop on a U.S.-China trade deal, I can't help but think either there's going to be no pop or he's going to be completely wrong. The chances of a prairie dog actually happening now is almost zero. That's
almost
like,
zero.
It's almost zero.
You said it.
So
you know what we're gonna do is I'm gonna cut out those clips of those prairie dogs doing that dance, and I'm gonna just keep that on my computer, and I'm gonna play it every once in a while, just when I think the market's popping. And
you know what? I forgot to mention the prairie dog is a noble animal.
It is a noble animal. You've made this very clear to our listeners on many occasions. But
I am a prairie boy, and the prairie dog is
great job. Great job. I mean, how long have you held that prairie dog clip to find something that you can mismatch with this?
Well, no, but actually I didn't. I went and found it because the Professor Siegel I was looking for something to do a WTF clip on, and when I saw him, advocating full out prairie dog, I thought, oh, geez, if there was ever a chance to kind of put in the National Geographic prairie dog kind of video montage, here it is. And I was quite surprised. Actually, it's a little sad. I didn't put in the whole thing, but one of the prairie dogs unfortunately didn't make it from the fox.
And the other one celebrated.
Yeah, I know. Isn't that the worst thing in the world? They're like, it's not me. It's not me. Well, anyways, that's what we as traders should do when we get it right. When there's something big like that, we should all just kind of prairie dog it and have a little dance. It wasn't me. It wasn't me. Anyways.
Hey,
here we go. Another beer.
I started, but I had to switch. I ran out of the St. Mary Axe beers. I only had 2 of the cans from our sponsor. I switched to this Hop City 8th Sin.
Yeah. Well, listen, that's what we have to talk to our sponsors about, that they are sending not enough product.
They're not sending enough product for us to finish taping a show.
That's right. Okay, so let's move on to, what is it? The top 5 things
to watch next week. But what we did need to do is first, before we get into the top 5 things to watch next week, we have to talk about last week, right?
That's right.
And so, number 5, we were talking about oil. And more importantly, we were asking that really important question: was oil going to be able to beat this kind of 60-61 level where that 200-day moving average lied? Now, let me just put up a 200-day moving average here. And we still haven't beat it. It's still edging higher. We had a very good conversation between me and you earlier today, which you said, I don't know why you guys are so bearish, right?
Yeah, that's right.
But
Is that your impression of me, by the way? I don't
no,
know.
I'm drunk.
You guys are so
I'm
bearish.
drunk. And so,
but I do agree that it seems to be that anyone kind of the wise guy traders, everyone loves to sell oil. It's one of those things that's just they love to sell it, and they all think it's going down. It seems to be the more you know about oil, the more bearish you are. And I just find it kind of fascinating. And yet it continues to just climb that wall of worry. And I don't see what you guys are all worried about.
Well, I'll tell you what. Wouldn't it be interesting, now that we're in this prairie dog theme, that if it went and tapped the 200-day moving average and then fell right back to 57 on the downside, that we would truly have to classify that as a prairie dog on oil?
Yeah, you're right. That would be a classic prairie
dog. But I'm not saying it will happen. I'm just saying, wouldn't it be interesting if that happened? Anyway, so oil, we were watching it. It's still here. We'll keep an eye out in the coming weeks, and so we'll watch what continues to happen here. So next thing, these Canadian banks. Now, we talked about obviously Steve Eisman getting. Obviously famous for his big short on U.S. Real estate back in 2007, 2008, getting bearish Canadian banks.
Isn't it Steve Cottrell? Isn't that his name? I thought it was Steve Cottrell.
It's Steve Eisman, I'm pretty sure. But you see the chart here. As a technician, I see a bearish engulfing candle kind of... developing.
Here it comes. Actually, I'm dialing as you're doing that with your bearish engulfing the channel. Or whatever it is, candle. I'm pulling them up, and they all look like death, man. They're trading terribly.
Yes, they are.
Like you go through them: Royal Bank, Bank of Nova Scotia.
The worst one is Bank of Nova Scotia. You know what? Look, the other major banks seem a little toppy, but Bank of Nova Scotia can't. They're lagging the group by a long shot. What the hell's going on there?
Well,
to be honest, I kind of look at the banks as on a macro scale. I won't lie that I don't micro analyze the different banks in terms of comparative analysis. But Bank of Nova Scotia technically is just so weak compared to the other five.
And they're all terrible though. I don't really see.
They're all
what
terrible.
You're talking
they're all
about
terrible.
like they're all.
But they had a great run in January recovering. The January and early February pop was meaningful, but they've really gotten heavy here.
So you know how I feel. I'm a bear on Canadian banks versus U.S. banks.
I'm a bear on both Canadian and U.S. banks. So there you go.
Yeah, you are. Well, you're a bear on almost everything. And you know what I hate even more than Canadian banks is Australian banks. And actually, I don't even know how to dial those ones. I'm not good enough to. I always forget the symbols.
Here's the chart on the Commonwealth Bank in Australia right here, and so this is CBA in Australia. On this Australian exchange. So, I mean, they've never recovered back to their 2017 high. So, like, Commonwealth was up at $88. And this most recent rally got it back to 75. But that looks like it's rolling over. Like, I wouldn't have a problem shorting Commonwealth here.
Yeah, but, almost the Canadian banks look worse than that.
They look like they have more downside potential, don't you think?
For sure, I agree, and it'll be interesting to see what happens because they've run a long way, and you'll probably tell me some retracement level or something. Like if you look at Royal Bank, it was $89 on the December 24th kind of panic, and it's now
Oh, you're talking. Okay, here I accidentally pulled up the U.S. Royal Bank.
Yeah, you got to pull up the
Canada.
Canadian.
So here's the Canadian one. Oh wow, what a break today. I didn't even notice that.
So, if you do your squiggly kind of Fibonacci, whatever it is, it very easily goes to $98 or something, right? Like it's do your squiggles.
The squiggle says 96.
There you
96,
go.
97.
So I can't disagree with the squiggles. I'm bearish. I'm a seller.
Well, if we both agree there's a problem, so
That's right.
everyone
We're headed
buy the
higher.
banks.
Yeah, there you go, boys and girls. Buy the banks.
All right. So we talked number 3, the Euro, Aussie, and Canadian. They look like shit, dude. These currencies are awful.
Every week you tell me how we have
I
to
know.
watch the
Listen.
U.S. dollar and how this thing is going to break out and it's
No, this
big
is
deal.
Ryan getting in your head. You know what? You have your little wingman over there, and you guys start chirping, and then suddenly you agree with him, and you have to pine in this way. Look, this is the biggest macro move of the year if the euro breaks. There is no doubt about this. How can we not be talking about this, Kev?
So listen. The biggest macro move of the year is coming up on our top 5 here. So you hold on for that. But I'm
not saying it broke yet, but I'm just saying that if the euro was to break down to 110 and maybe even back to where it was trading near 105, that's a pretty big macro move.
Yeah,
and very relevant. That's a dollar index going north of 100.
Yeah, I guess so. You know what? I just don't think it's that big a deal. The dollar's gone sideways.
Oh, Jesus.
So
you are so wrong. You are so wrong.
Yeah, so I'm more... Okay, so listen. I have kind of philosophical difference of opinions with you. You think that the absolute level matters, and to me, on the currencies, I think that the speed of the move matters more than the absolute levels. So if the dollar kind of grinds higher,
like Japanese
I'm not
yen.
going to
Stop for a second. So this Japanese yen move right here, because the speed from which this yen rallied and the U.S. dollar collapsed in that move made it relevant. It didn't make it relevant.
No, I disagree with you. That was a sign of the stress, and that was during the December.
What stress did it cause? What stress did it cause?
Oh, no,
All I'm
wait.
saying.
Which way are you looking at it? You're looking at it backwards again.
No, not backwards. I'm looking at the yen. You want me to look at the U.S. dollar yen to make you happy? Fine.
Yeah, I got it.
All right. So here's your little breakdown.
Yeah. So
of the
that was symptomatic of the December swoon in the risk assets. And it was a sign that the markets couldn't take that move. And that is why that speed was indicative of that there was problems in the market.
So all our listeners now know that it's not whether the dollar breaks or the euro breaks down, the dollar breaks out or the euro breaks down. It's the speed from which it happens that matters to Kevin. So it's on record.
There we go. It's on records. Yep, you're absolutely correct. If the dollar just grinds higher, I will have no problems with it. If it starts to take off and goes from 98 to 104 in a swoosh, then I will be nervous.
All right. So, number 2, we talked about treasury bonds. And here's a 10-year treasury bond with that nice rip to the 125 handle to the upside. You know what, Kev? What a great move! I made some good money on treasury bonds here in the last in the last couple of weeks on this rise. But I'll tell you, I feel that this move's gotten a little bit ahead of itself. I'm thinking here that this is a great place for a collar. I've published it to my members. I'm option collaring in on our treasury bond positioning to not still have upside. But I think that this is a good place to lock it in. There's room, I think, for the fact that bonds made this big move for it to mean revert a little bit. I'm still very bullish bonds.
Yeah.
From the bond bear on the other side, he has nothing to say.
Okay, so listen, I knew this was coming. I knew this was coming. No. This is coming. So this is actually one of the few cases where we both can be right. And just for full disclosure, Patrick phoned me up to basically rub salt in my wound.
Oh, Jesus.
You did. You phoned me up to tell me how wrong I was about bonds. And I was like, what do you mean how wrong I was about bonds? I've been telling you to buy the 530 yield
No,
curve.
you've been dead right about the 530s.
Yeah.
Okay, no, I'll give you that. But, I mean, listen, that's where we've been both right.
Yeah.
Fine.
And listen. Timestamp a ticket, because this is going to happen very rarely that we're both right. It's more often that we're both wrong, even when we have opposing positions. But I do think it was interesting that you kind of thought that it had gone too far. And I'll just kind of throw this out there. Although I still think I'm long term. I'm a bond bear, no doubt about it. That'll be difficult to beat out of me. A little bit of a bond move. Won't
with
stop me.
MMT coming around the corner, you're going to be almost.
But I
do
think that the 530 spread has gone like a long way, and I'm actually looking for the first time. I looked at what Eurodollars and Fed fund futures were pricing in terms of the amount of easing that they're expecting over the next year or two, and I think you should be shorting the front end of the curve. Like, this is ridiculous.
So here's the interesting one. So this is what I did here is I did a spread between I kind of mismatched. So I went June to December. So June 2019 to December 2020. So this is an 18-month spread.
So to me, that spread should be bought all day long because I think it's pricing in 47.5, basically.
Well, at one point it was 56 basis points 2 days ago.
Not a chance. Listen, that's one of those things that we're going nowhere. I don't think we're cutting. I don't think we're raising.
But this is to December 2020.
Yeah,
you could make me a 2019 forecast and I'll drink your Kool-Aid, but you're talking 2020, dude.
Yeah, I still think the market is underappreciated.
There was that great, I wanted to talk about it. Maybe we'll bring it up next week. But there was that trader that in the Eurodollar markets was putting on a condor trade, betting that the Eurodollars were going to pull back on this. He was basically calling for the fact that the market completely overshot, and he put on like a $30 million condor. To betting that this is all going to mean revert. So he's agreeing with you.
Patrick, I have something to tell you. That was me.
That was.
Let's move on to the next trade.
So the GDP number came in at 2.2. Now, from what I saw, at least on my sources, it was anticipated to be 2.4.
Yeah.
Right, so it came under expectation. Was that right?
GDP is one of those late things. Like, I know we put it as number one, but
of course,
one of those things.
And by the time the NBER confirms the recession's goddamn over.
Yeah.
The fact that you need 2 quarters of negative GDP and the GDP being lagging in the first place means that you're probably like 7, 8, 9 months into a recession before anyone says, "Oh, by the way, we're in a recession."
Yeah, well, wasn't that the thing that I believe that when Clinton beat the first George Bush, there was all about the economy stupid, but the reality was the economy was already out of the recession.
Yeah,
I think it was something like that. Like we just didn't realize it yet. Anyways. That's it for last week. Let's move on to next week's.
Yeah, so top 5 things to watch next week. And so for this, the first thing I wanted to talk about is this emerging markets currency breakdown. And you put together, you grabbed this Bloomberg chart here. So what's this basket about very quickly?
So that is the JP Morgan submerging foreign exchange index, and I'm not sure exactly what it's got in there, but it shows you kind of a good smorgasbord of the emerging markets.
It's rolling over. It's rolling over. And the one currency that caught my eye by far has to have been the Argentinian peso. And it's broken to fresh new lows. And I mean, this is not chump change. Like since 2008, January 2018, the Argentinian peso is down 61%.
Okay, but what's it down? So here you go. You're like, what is it?
What's
down
it down?
In
in the last 1 month, down 20%.
I guess so, but like it's just.
I guess 20. You know what? If the Canadian dollar's down 20%, you'd be shitting your pants, and suddenly it's Argentinian peso, and it means nothing, right?
No, we're not. We're not like an emerging market, although sometimes, based on our politics, it feels that way. But okay, pick another one. Show me another one. Let's go through.
All right, sure. Let's say the Brazilian real. I mean, it's slowly rolling over. I mean, this isn't fully selling yet, but I mean, it's getting heavy, and that's a very weak price action in the last little bit, right? And
you're right.
You take the South African rand. That I mean, if the rand gives out these lows all along here, that's a full on rollover. Then take the Turkish lira. I mean, fine, this has been messy here, but it's the CDSs and all that other crazy shit that's been going on over there. But everything in the Turkish market is starting to get haywire, including their stock market. But I asked the question, is the entire emerging market space starting to show the warning signs that shit's hitting the fan again?
Well, I think the fact that we got it in our top 5 means that it's pretty safe.
What do you mean? Nobody's talking about this, dude. We're ahead of the curve here. We're ahead of the curve. We're not.
You know what the trouble is?
Something.
I am ultimately a little bit of an emerging market bull, like over the long run. So
over the long run, okay, fine. Yeah. You know what? I've said this so many times. Over the long run, you could listen. You're just echoing Howard Marks or any of these other guys for sure. The growth prospects and the all of it, the valuations, everything is amazing on emerging markets. But if you think about where the recession is happening real time, where the real stresses in the global market is, it's all in the EM. I'm in the bear EM camp for now. At some point, I'll be completely in the long-term bull camp with you. I will definitely. I'm a trader. I'll buy the EM space when it's time. I think the EM's going lower first.
Okay, well, there you go. You heard it. I'll give you the bull argument. The Turkish situation was pretty dire. Like it was all over zero hedge, like whatever the 1,600% overnight rate or whatever it was. If that's the worst that's going to happen in that sort of environment, then it's not that bad. And maybe, you know what, it's just kind of one of those idiosyncratic kind of issues that pops up at month end, and we're going to look back a week later and go, what were we so worried about?
All right. Well, listen, to me, this currency chart looks like shit, and it has lots of room to go lower. I'm bearish.
Okay, that sounds well. There you go.
So, second, let's talk about this Lyft IPO. Is this a boom or bust?
There you go again. It has to be one or the other.
No, okay, it doesn't have to be one or the other. What's your thinking? I just had to do that for. Listen, we're in the entertainment business, so we have to entertain.
I thought it was interesting, and we're going to talk a little bit about this with Kieran in the after show, but I thought it was interesting that many people have talked about the fact that the private valuations are extended to the point where when it finally comes public that it can't actually achieve a level that is supported by the private valuations earlier. Yet, I'm pretty sure that Lyft never traded as high as it did today and in the public markets. So I'm not so sure that this is some sort of sign that things are bad. And I kind of look at this and say, yeah, this is the signs of a frothy market, but it doesn't necessarily mean that it's going to end tomorrow.
So when Facebook IPO'd, let me just go back over here. When Facebook IPO'd, it hit $45. So the first day of selling dropped down to about $38. 2 weeks later, it was down to 27, and then 3 months later, it was down to 18. Right, like you're talking 60+% wipeout, and then that was one of the most epic buying opportunities on Facebook. The point is, forget whether Lyft is going to be an amazing opportunity or not, but could we see a deja vu of Facebook's IPO?
So you think it's going to get halved or even
more?
No,
I'm asking. I don't know. To be honest, this is
I'm more bullish than you are. If anybody's going to say it's going to get halved, it's you. I don't think that's the case.
Look,
and not only that, Uber's still ahead of us, man. Like if this was the case, this is just Lyft trying to get out ahead of the real big one, which is Uber. Uber's like the big gorilla versus a Lyft.
Okay, but I'm sorry, but Facebook doing this, I think Facebook was a pretty big kahuna back then.
Oh yeah,
right?
No, I agree. But I'm saying Facebook was more the Uber than it was the Lyft. That's kind of my argument.
Right. So when do you know when Uber comes out?
I think I'm not sure. I don't know. I think it's to some extent it's market determinant, right? Like there's no real like specific time. Did they file their S1 or whatever it was? Like I think.
Are you a buyer or a seller at this price on Lyft?
Well, listen. IPOs in general are not good things to buy. Like I saw some study by some quant that over the long run IPOs underperform the market, all the time. Interestingly enough, why don't you pull up a chart? There's an ETF on this. Of course there is, because there's an ETF on everything. And it's IPO. And I was shocked at this is kind of just the most recent IPOs, and they'll hold it for a year or two. I can't remember the exact number. But these things have just flown. Like it's crazy. Like what is that return from the lows in December? Like can you dial it for me? Like what is that?
Yeah. So since December it's up 47%.
Like
holy shit.
Yeah. It's kind of nuts, right?
Okay, but at the same time, I mean it did wipe out 30%.
Yeah.
During the December pullback.
Yeah, so these are volatile.
But that's still
stocks.
crazy numbers, dude. This is like the market on steroids.
For sure, and it's one of those things that it's something you should watch as the canary in the coal mine and stuff. And it's interesting. I think you should dial this and keep this on your radar, this IPO ETF, because I think it's interesting.
Yeah, I agree. So number 3, palladium.
Oh. So palladium is a metal dear to my heart. I've watched it for a long time. I've written a couple posts about it. The market went in kind of the.
What the hell happened here? Does that limit down shit?
I don't know, man. It's crazy. But more important than the recent decline, do your magic in terms of figuring out what that move off the lows in September was.
Oh yeah, no. And what's amazing is it made this rise. Without any of the other precious metals running, right?
Yeah,
93%.
So it doubled almost, right? Like that's
in 217 days. So like,
it was the greatest bull market that we had out there. So everybody's like freaking out now because it's declined in 2 days. It's went down whatever that number is.
Well, in the last week, it's down like 16%.
Yeah, that's not that bad. Like, listen.
That's from 1,600 to 1,400, but it's
that's
just,
what happens in bull markets. In big bull markets, you get the biggest corrections, right?
Yeah. Too bad there wasn't really a good liquid options market for
Well,
this.
listen, you can trade. There is an ETF based upon this, but
but there's not a good liquid options market for it.
Okay. When you're trading your 1,000 lots, you're having trouble getting filled?
Oh, I can't get any fills.
You can't get any fills on it. But I will tell you one thing that's interesting. I recently read kind of a research report on platinum. Because don't forget, one of the reasons that palladium ran and platinum didn't is this whole Dieselgate. When we think back to the fact that the palladium and platinum are both used in catalytic converters, which is, I guess you might argue that they both should be going down because of the reality is that we're using less and less kind of fossil fuel cars, but it definitely hurt platinum when the Volkswagen had all their troubles with their diesel cars, and platinum is used more in creating catalytic converters for diesels, whereas palladium is used more on a traditional gas engine. But the thing about it is that they are somewhat substitutable. Yet the thing about it is that it takes a while for the car companies, to retool their factories and make these things differently. So it's not something they do the moment that platinum is, $100 cheaper than palladium. And I contend that there is a chance that we finally have hit a point where, hey, platinum is half of palladium. It's time to go about and change
fade it the other way.
Yeah. And it's
really?
kind of scary. Well, at the very least,
are you doing one of your fancy pair trades?
No. So at the very least,
go long platinum against the short palladium.
No, so I haven't done that. One of my fancy trades, but I will tell you this: I am watching platinum for a cheap, something to buy, because platinum is not moved up with palladium, and maybe it just solves itself by platinum grinding back higher.
But platinum has really moved in line with silver for some reason. Like when you look at the platinum chart and the silver chart, they don't look that far different.
No, you're right there.
Right.
Silver
Like
is sagging and not doing that well.
They seem to have like this kind of the precious metals that are in the doghouse kind of look to them.
Yeah. Well, anyways, there's smarter guys.
It's worth watching. So, do you think this pullback marks a major top?
Oh, geez.
Yes or no? Come on. Just stick your neck out for once.
Okay. Yes, it's the top.
Okay. You heard it from Kevin Muir. I have no opinion.
Okay, here we go.
All right.
I kind of alluded to this earlier. I'm going to take this one, Patrick.
All right.
I was shocked that I didn't realize what the trade of the year was.
There was a trade of the year?
Yeah.
I thought it was short Tesla.
No. The trade of the year, according to Dennis Gartman, Gartman, I think I said that wrong. Dennis Gartman, the kind of famed commodity guru, is long gold in euros. What does that mean? It basically means you buy gold and you short euros against it.
So here's your gold euro trade, trading at 1,152 euros an ounce.
So I think you're a big euro bear. You must be kind of upset that the famed...
No, this makes sense to me, doesn't it?
Okay. Yeah, I know.
Because that's the base currency, so the more it goes down, the higher gold goes.
No, I get it, but Dennis has got kind of a reputation as being the ultimate.
Well,
favorite.
I mean, it makes me nervous when Dennis is on my team.
Having said that, he became the butt of a lot of jokes of zero hedge and stuff, and then he actually started to get some calls right. Yeah. Just when you thought that it was for sure
the zero hedge guys were confused. It's like you got all the algos all messed up.
That's right. When the algos finally figured out that was a way, to make money, it went the other way. Yeah, just to mess up all the algos.
But it's kind of, Dennis is making the call after this trade has already moved almost 20%. I mean, it's 17% off of was at its peak, so you have a trend that's been in place for 3-4 months that is 20% off, and then now he's making the call. Look, I'm long-term bullish gold. I think you may be too. Maybe just double check.
Yeah, no, I think for sure.
So I'm long-term bullish, but so let me look at gold against the CAD, right? So you look at gold priced in Canadian dollars, doesn't look that much different. This rise in gold here against the Canadian dollar has been about 17%, about the same percentage. You take the gold against the Aussie, right?
I think that's even better. I think that one's hitting new
that's
highs.
a cleaner looking chart. I mean, it's pretty much at major highs. Yeah. And that one. Off of that low, about 17% in the last push since the summer. So you know what I mean? Like, really, in my mind, it's a derivative of the fact that you expect that the U.S. dollar will work, but it's the fact that gold will do better than all of these cross currencies weakening. Right.
Yeah, and he's also arguing that
it's your pair trade. This is the way this is your territory. It's
fancy. I get it.
It's
fancy. I think he's arguing that that Europe's going to get themselves into a lot of trouble, and that when you think about it, they're going to be forced to stimulate and do all sorts of monetary madness, and therefore, if you're a European and you're looking at somewhere to hide,
but why is that just not being short the euro against the USD?
I think it's just
that's what would accelerate this gold trade higher.
Yeah, no, it's the same trade, right? Like it's the same thing.
Trade. It's the same trade.
Anyways, there you go.
But you know what? Dennis Gartman wants to be on the record for making it fancy, and he gets the award for making it fancy.
Well, and it's the trade of the year. That's the important thing. I'm
but you
much
know what?
too much of a coward to call anything the trade of the year.
Hence why we have been on this show talking about that euro level for how many weeks in a row? To the point that Ryan had to pine in and say
it's like 9 years. I think we've been talking about the potential breakdown in the euro and the rally in the dollar. One of these days it'll actually happen, And I'll be so sick of it, I won't want to talk about it. Okay, number 1. Let's go have a look.
Number 1. Now, we know that Kieran's going to pine in on Tesla. We're going to get into this with him in just a moment. But Tesla is at a very critical level, isn't it?
Yeah.
Right? Like, we are... I personally feel that 250 is the line in the sand. Because if the bulls are going to hold the line and keep this stock in any remotely bullish trend, they're going to hold the line at 250.
You know what the interesting thing is, as well, not only do they have to hold it from a technical basis, but I believe that good old Elon has all sorts of margin calls right below there.
Yeah, something like 230, I heard, or something.
Yeah, I think it is.
Am I right on the number? But anyway, I don't know the exact number. I'm making shit up now. But it was definitely somewhere under there that there are margin call risks, and so you have to believe that they're gonna do to me. I'm actually giving the bulls the benefit of the doubt that they're gonna hold the line here, because to be honest, any price action below here is in my mind the beginning of the end, and I don't think they're gonna let it go that easily.
Okay, so I just looked it up. For according to that source that you love to quote, Zero Hedge, it's basically it's as good as Wikipedia. $232.
$232.
So it must be right if it's in Zero Hedge.
It must be right. So the bottom line is that I listen. I honestly look. I'm bearish. I'm bearish Tesla. I think it's going lower. But you have to believe the bulls will at least do a valiant attempt to hold the line here. If you read this tape and the bulls can't even muster up a counterattack off the support and try to drive the price back north of 300, Tesla's done. The way I look at it, in the next couple of weeks, I believe that Tesla will be north of 300 because I think the bulls are going to give it a shot. But I'll tell you, if we're 2, 3, 4 weeks here and we're under 300 consistently, then Tesla is fucked.
So there you go, you guys. It's a typical technical analysis.
Well, look,
if it goes higher, it goes higher, and I'll buy it. And if it goes short,
I'm not buying it on the higher. I'm just saying that the bulls got to get it off of this low, right? Like if they're going to defend it, they have to try to reverse it off of here. I mean, that's the only way to keep this thing alive.
Yeah, no, I will say one thing, that if it breaks that level, and I'm the first one to kind of fade a break in a level, saying it's not that big a deal. But I think in this case, if it breaks that level, it's gonna run like it stole something. Like it's just gonna go 320, and before you know it, it'll be 250. That is the prediction I'll give you, and that is unfortunately very kind of typical of technical analysis. They'll say, if it goes lower, it'll break and it'll keep going. But I think in this case, it's not the kind of stock to be cued on.
Are you making fun of technical analysis?
No, never.
No?
No.
Because I can't help but to feel you're doing that.
No.
All right.
But anyways, so if it goes lower and breaks, I think that this is one of those that you can jump
stop
on.
Stop for a second. So let's clarify. So I'm going to draw a chart here. Let me just quickly type a few things in here. So this is Kevin Muir style technical analysis right here. Okay, here, perfect, right here. Okay, so down here, Kevin is bearish on the market, and Patrick is bullish. Then up here, Kevin is bullish, and Patrick is bearish. So
that is
what
awesome.
exactly in technical analysis am I getting wrong here?
No, that is actually very good. Good analysis. I like that.
Right?
Was I bearish that quickly? Was I actually bearish that quickly? I might have been, actually.
You were saying that was going to last no more than a couple of weeks.
Yeah, no, so I'll tell you.
So
I should listen. I should have listened to you more. I kept thinking that Powell was not going to.
All I'm saying is you're shitting on technical analysis a little too much.
Yeah, no. Listen, And touche, that's what you got to keep my feet to the fire. You got to keep me honest. I like it.
But it's funny. It's funny. Yep. There's this one guy. I have to. We never read the YouTube comments, but I'm gonna validate one, because on Macro Voices there's this one guy. Whenever Eric talks about some technical levels, there's one guy on the YouTube down in the comments that always, every single podcast that gets released on YouTube has to come in there and say technical analysis, blah, 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 blah. And he just like barfs all over technical analysis. And he does it every week. All listeners, go look it up and find out who this guy is. But he comes every week relentlessly, just in case we didn't hear him the week before, that he has to come on there and shit on it. So I think it's really funny.
Well, that could be, and I appreciate you keeping me honest, and I won't deny that in the least, that Powell threw me for a loop. I completely expected him to continue trying to keep the markets down, and he got me. So
Kev, if the market makes a higher high here, are you going to be bullish?
Well, I've already told you that I think that I think that there's a chance that we go a lot higher.
Right.
And
right.
If
it does make a higher high, are you more bullish or less bullish?
No. Okay. So listen, I gotta tell. Okay, you know what? If we're throwing rocks and or throwing stones, I gotta tell one thing to our listeners. You phoned me up this week to basically rub salt in my wounds, right? And you were because I had gotten somewhat bullish. And I must say, your timing was impeccable.
Okay.
Pull up the chart of the S&P over the last week.
All right, hold on. So last week, what do you want? Here, I'll put a 4-hour chart up.
Yeah.
All right, here.
Okay, let me see it.
So where do you want me to mark off? When was our phone call?
It was, I can't remember exactly, but it was literally one of those lows. It was either, and I was like laughing. It was that one, or I think it was actually the other one. Because I think it was the next, it was there. And you phoned me up, and I was like, oh, geez, you know what? He's right. I'm like off like 8. I remember thinking to myself, it's like 40 or how many handles is it off the highs on the S&P there?
Off of the highs? Let's see here. I mean, we're talking, it's like a couple percent off. It was almost 80 points off the high.
Yeah, so it was 80 points off the highs, and I was thinking, you know what, he's right. I'm like, not that I bought the highs because I think I was a day or two early, but anyways, I was thinking it's 80 handles off the highs. Maybe he's right. And just as I was doubting myself from your little chirping in my ear, I saw the market make a bottom, and I was like, oh, good. There you go. The market gods were listening to him. He tried to kind of shame me, and the market gods knew, and they came around to fix that problem.
All right, so enough public flogging. We're going to have to continue this over a couple beers when we meet up this evening.
That's right.
With a bunch of our listeners at our first
Market Huddle
gathering.
Meetup. That's right.
Our first Market Huddle meetup. So I'm dying. Like, by the time anyone's listening to this, it would have already happened because we're not editing this and launching until Saturday. But we're looking forward to it. We're going to continue this shitting on each other stuff over a couple more beers, right?
And unfortunately, I think there's going to be a lot of your members there, and I think that they've been programmed by you to think that I'm wrong. Anyways, let's go on. Let's go to the party of wisdom.
So you had some words of wisdom from Jim Simmons, of all people.
Yeah, you know what? Given Kieran's background with his grandfather working at Renaissance and being the second employee, or third employee, but the second real employee, I thought that it was time to pull Jim Simmons, the founder of Renaissance, one of his quotes, and I thought it was a pretty good one. He says, patterns of price movement are not random. However, they're close enough to random so that getting some edge out of it is not easy and not so obvious, thank God. Actually, God doesn't care. Thank whoever. That was kind of funny. That God has nothing. Is not really very sympathetic to futures traders and or speculators of any sorts. And Jim Simmons realized that. So there you go. There's some parting wisdom from Jim Simmons.
All right. Well, listen. Thank you all for spending some time with us. Please visit our website, markethuddle.com, and sign up to receive our weekly emails. And subscribe to the channel, please. do this. Click that subscribe button. If you made it this far into the show, how could you not subscribe?
That's right. And remember to stick around for Kieran's going to be on with some great after hours stuff, and it's going to be terrific. And I just want to thank everybody. You can follow me, Kevin, on Twitter at Kevin Muir.
How about the Market Huddle twit?
Yeah, well, we're going to get to that, Patrick, if you didn't step all over me. At Patrick Cerezna, and for those of us that aren't from wherever he is and have trouble spelling that, it's CERSNA. Have I got that right?
No, you don't, actually.
Oh, there you go. Try it again.
CERSNA.
Yeah, there you go. Actually, to be fair, a lot of people have trouble with my name as well, so it's not like I have the easiest name.
M-I-U-R?
Yeah, that's correct. And you know what? I can always tell people that are from San Francisco because John
Or are you
Muir,
sure it's not M-U-I-R?
Yeah, John Muir was the father of the national park system in terms of in the United States, and he has the Muir Woods, which is just outside San Francisco. So I can always tell the people that have no trouble at all are always those from the West Coast. Anyways, thanks for listening. Stick around for Kieran; it's going to be great, and look forward to hearing from everyone next week. Thanks for listening.
All right, thanks for listening.
Okay, Kieran, we got to start with this video game thing. I was looking at your bio, and I'm just fascinated by the fact that you were once ranked number 2 for some video game I never heard of. You have to give me a break. I'm in my late 40s. I don't know all the video games.
I think the game died a lot since I stopped playing it. So
yeah,
it's probably pretty good.
You were number 2 in the world. Yeah, what game was it?
Yeah, the game was called Smite. It's MOBA, or I think the MOBA stands for Massive Online Battle Arena. It's like League of Legends, but I thought it was more enjoyable. You probably didn't know what I just said, but.
But you were ranked number 2 in the world, and there was literally like millions, more than 10 million people playing this. Is this correct?
There were 10 million accounts. I don't know, probably in the millions of people that played.
Okay, so now I have a question for you. You've gone on to be a hedge fund manager, and I'm wondering if you're regretting this decision because nowadays I believe that the kids these days are making more money being video game players than they are being hedge fund managers.
Yeah, I sort of left right before that all took off, and you look at the stocks that sort of trade on, like NVIDIA or what is it, Activision or whatever, right? Those all. I think I pretty much me leaving the video game world was like the inflection point. All those stocks and stuff. I honestly to the month maybe. And so I obviously didn't buy any of those. So I ran away from video games as far as that sort of life. And so those went up.
So
like
what
5,
I find,
10x, it was
so what
really
I find fascinating. Sorry. Sorry, Kieran. I keep stepping all over you, bud. Yeah. So what I find fascinating is the fact that people actually pay money to go watch like an arena and watch people play video games. What is that about? Like explain the phenomenon to me because I don't get it. And after you've done explaining that to me, you can explain electronic dance music where people go and watch somebody press play on their computer.
Oh, I can't explain the EDM part, but I don't do that either. So. Yeah, I mean, it's just like any other game. I mean, why do people watch golf? Why, there's a, especially for me as a guy who played games pretty competitively, I enjoyed the skill and watching and trying to understand the thought process and just appreciating the amount of skill that it takes to do these kind of maneuvers and the thought process. And to me, it's just like watching any sport. I still do watch. I don't watch Smite. I watch StarCraft 2. From time to time still.
Okay.
Which I don't even play. I haven't played that in a decade or something. But I just really enjoy just understanding and appreciating the skill that it takes. Just like I said, any other sport.
Okay, so let's talk some markets now.
Yeah.
Apart from being an unbelievable geopolitical analyst, you're also a little bit of a biotech kind of specialist, or you'll pretend you're not, but you understand more so than Patrick and I for sure. Let's start with that. Why don't you tell us a little bit about your experience there, and maybe we could talk a little biotechs because I think that you might have something that our listeners find interesting.
Right. I mean, let me say, I'm not the expert. My brother is the expert who has been able to develop his own theories that are orthogonal to this current mainstream understanding of biotech. And so we have some pretty unique insight into the whole space simply because we're coming at this from a completely different lens, and we can see value where no one else sees it. And more importantly, we can sort of, we can see sort of how the micro is evolving and how the technology is evolved. And to us, some of the technologies that are coming out of this space are just so fascinating to us. And so, before we were looking at the space, we had no idea. I mean, we didn't start looking at it until early 2017. And then we started digging into it, and there's actually some really, really promising game-changing therapies for a lot of diseases that are not, and I'm not saying they're coming out this year, but they'll come out in the next 5-10 years, and it'll change, chronic kidney disease, heart disease, cancer, probably. Cancer is a little bit of a trickier one. Aging is another big one. And, there's sort of been no progress for decades in biotech, and, to sort of just start looking one day and find, a lot of progress or sort of a lot of potential coming down the pipe. It's very, very, promising or optimistic, fulfilling, I would say, life affirming. I don't know, sort of like, it just feels good to be able to find this sort of level of innovation again, that it's going on.
So Kieran, can I ask you? So I pulled up the chart here on the XBI.
Yep.
Now, if an investor was to just buy the basket of using the ETF for the ideas and themes that you're thinking, does that is it all encompassed if someone just bought the broader index, or do you have to be far more specific and dig to a couple of individual company names to get these different ideas?
That's a very, very good question. That's a very, very good question. And I can't speak for all the names in the index, obviously. But we sort of, most of our names, our biggest holdings are outside of the standard indices. It's not to say that there isn't a lot of good stuff happening, and you can sort of take advantage. There are other macro trends that you can take advantage of in that index, which, that we aren't really necessarily trying to capture. We're much more specific in our approach. But one of the things that really propelled the index this year is sort of all the gene therapy buyouts, and we don't personally, and cancer buyouts, and we don't actually invest in cancer or gene therapy. Simply because we have such a different perspective on how they work that we don't feel comfortable going down that route. But with that said, those have done very well, and they may continue to do well. Overall, you have to think about the trends that are sort of driving the space, and sort of the level of how computers and digitization and big data and algorithms are sort of enhancing how companies go about running drug trials, or sort of understanding how their drugs work, data mining patients, and all those sorts of things really improves the efficiency and our ability to develop drugs, like orders of magnitude, especially since just if you go back to the 90s or even the early 2000s, we just didn't have this level of ability to understand what the drugs are doing and be able to do it quickly and more cheaply. And so that's really a massive tailwind to the entire sector. And then there's also other tailwinds, which is, the whole world's just getting less healthy. And, I don't want to bring your viewers down, but, just overall, it's pretty clear that the human population, genetics and health is just deteriorating at a pretty rapid rate. There are a number of reasons behind that, but that should drive demand for biotech, et cetera, especially as the rest of the world sort of gains more wealth as they sort of move up the value chain. They'll be able to afford more drugs. So overall, I think it's a good way. We just, for us specifically, we are just way more specific in what we target, if that helps.
Okay. So, Kieran, I had to look up orthogonal. I'll be honest with you. So it's so statistically independent or involving right angles.
Yeah.
I'm not sure which one you're using there, but anyways, either way, you're thinking outside the box, I guess, for us lay people.
It's sort of a way of not saying everybody's saying. It's a nice way of saying we think everybody's wrong.
Okay, so why don't you tell us what you or maybe try to tell us in what way are people wrong, or is the market wrong? Because I don't really care about people. I care what the market's pricing. Like, what is the market missing or kind of not appreciating that you guys are appreciating, and where is the opportunity? And like, I don't want you to, like, if you're not comfortable, don't name specific stocks, but types of technology that or anything you can kind of like shed us some insight in terms of what you're thinking and where your thinking is different than the traditional kind of biotech investor.
Right. So on that, I would it really comes down to a sort of fundamental way in which we think about biology versus how the market, which is just the sum of people's ideas, right? How they think about biology. Like, really, it's fundamental type stuff, and we treat biology as a nonlinear, complex system, and that may sound sort of obvious considering it's a biological system. But the way it's sort of treated, the way the market and the way scientists, even in our companies that we go about their therapies and they're treating their therapies, they just don't see it that way for the most part. And that makes it very hard at times to sort of invest in companies, even with good drugs, because they won't know how to dose their drug or what therapies to go after some of the time. They're really doing it based on a more, I guess this is getting away from your question a little bit, but there's just a big fundamental misunderstanding in terms of what life actually is, and is it sort of, and that I can't really speak to the philosophical component like my brother does, who has developed all these theories that we use. But the biggest thing is just sort of the nonlinearity, because we'll invest in companies where the dosing will confuse investors and what works and what doesn't work, right? If you go too high in a dose, the drug may not work at all. And the same thing is, if you go too low as well, it may not work at all. And there's sort of like a sweet spot in how you want to dose, and that will completely throw off investors, because if they don't see a sort of what they think of as a dose response, where the more you give, the better it should work, right? And then maybe if you give too much, you get toxicity feedback. But they don't see it as an overall, where you get this nonlinear component where you have to, to get the best effects, you have to dose it just right. And so a lot of the times we'll invest in companies with late stage drugs that are super cheap. I mean, we've only been doing this for 2 years, so we haven't had too many phase 3 trials yet, but those are coming finally this year, which is going to be really exciting. And the whole point is, these companies will run phase 2 drugs trials, and they'll show a lot of the time that their drugs don't work non-linearly, and they'll have, only one of the dosages will work really well, and the other will just be flops. And so the market will just focus on, that only worked for one of these, so and they don't understand the science enough to be able to say definitively that it'll work. And so because it failed with most of them, they'll sort of just run away afraid, and the company will be devalued. And that's sort of been a sort of frustrating learning curve for us, because learning how the market thinks versus how we think.
Could that just not be a discounting mechanism where they say that if it only works with one dose, that it could be a bad sample, and that therefore there's a certain probability that it's not an effective drug, and therefore they have to discount that into the price? Like, could it just be just the way that they discount this?
I think, it obviously is, but we just sort of disagree. I mean, why are they doing that though? It's because they don't fundamentally understand or have a better understanding of the actual science. For them, it's a lot of sort of data mining and sort of seeing what has worked in mice or rats and sort of trying to guess at what the mechanism of action could be, rather than sort of understanding what it actually is. And for some of our drugs, we don't actually understand fully what the mechanism of action truly is, because it's so complex and so new, with sort of like epigenetic drugs, which we try not to invest in too much unless there's a lot of data in. even for us. So, I mean, I understand the uncertainty, but I'm just saying the uncertainty stems from a lack of understanding and trust in the underlying science, because they just don't know. And they haven't put in the research, they haven't put in the work. And my brother has. I mean, he has had, I think he has over half a dozen autoimmune diseases that he's had to self-treat due to the failure of, modern medicine, essentially. And so in order to treat himself, he's had to learn how biology works, and he's had to be his own guinea pig for a while, and develop his own theories off of existing research. So that's important. It's not like he's in the lab doing experiments or anything. No, there's been a lot of great research that's been done over the last, 50, 60 years. And with the advent of the internet, you can just pull that out and, find interesting data points and, see how that fits into your whole perspective. Sort of like what we do for macro, where we look for signals in the noise, right? And try and put a picture together, right? Except, our picture is constantly moving, right? And his is a lot more static than ours is, right? Does that make sense?
Okay. Yeah, for sure. So let's move on to something that I know gets a lot of headlines, and some of you have been talking about, and you were mentioning that you're a little Tesla'd out.
Oh,
and,
God.
Aren't we all? But having said that, I just got to get your opinion of what you think. And
Sure.
Recently there was that great Real Vision piece that kind of, I thought very, very, really well presented both sides. And it's just, although I did see that my buddy Jawad, I don't know how to say his last name, but anyways, Jawad said something to the effect that both the bulls and bears are wasting way, way too much time on Tesla. And I kind of thought, oh, you know what? He's actually probably the most wise of us all. Just don't trade the thing because it's such a battleground. Anyways, I was wondering where you come down and what your thinking is on it.
Well, first off, I think Jawad has been and is completely right on that. Let me just say that right now. And he's warned me to stay away from that stock, and like I said, he was right. And, I mean, where the Tesla story is now, it's in a really interesting spot, obviously. I think the company's in big trouble right now because I'm obviously short the stock. It's a disclosure, I am short, but I use mostly long-dated put options, where I'm just betting on bankruptcy. And right now,
you're that much of a bear. You're like out of the money, like puts.
Oh, that's by full disclosure. I'm completely in with him. I've got long dated put spreads on the bankruptcy call. So
do you want to get a room?
Yeah.
Like, do you guys want to get a room?
Yeah, we're gonna have to.
Right. I mean, and so the whole story right now, I mean, Tesla's going to show year over year or quarter over quarter sales declines. This is after expanding into Europe and China, and then this is after launching the 35,000, which after launching the SR Plus, which is like a $38,000 Model 3, which probably doesn't even exist in the U.S. The point is, though, Tesla is essentially, in order to keep sales from completely collapsing, has to keep tapping into new markets that have pent up sort of stock that they've built up over the last 3 years since they launched the Model 3. And even by doing that, they've had to slash prices by as much as 40% on some of their models. And this has not been enough to prevent a complete collapse in their sales. And so going into Q2, after they've already cut sales, you're going to see, cut prices, in the U.S., you're going to see a further decline in sales of Teslas. And that could be catastrophic in Q2, but, who knows? Maybe they can stretch into Q3. But when you get to Q4, they have a $500 million bond payment, and I don't think they can make that if they tried. They're just going to be burning too much cash, not enough sales, and they're pretty much pissing off all their vendors at this point. And it's run very incompetently, and there's probably elements of fraud. So in the end, I'm just shorting a likely company that's fraud, that's a broken growth story at this point. And given the amount of leverage on the company, and the margin loans on their CEO and all his friends, it's just like a toxic mix. I'm not sure when it's going to go, but, that's why I sort of stopped focusing on it. I mean, I pulled off my naked short just so I don't have to worry about the daily fluctuations anymore. And so I'm just long dated put options at this point, just waiting for it to crash one day.
The one question, because I didn't look into it that much, and I just want to know if either of you two had an opinion on it. But there was that one headline, obviously on the highly credible Zero Hedge, that was something on the in the tune of like it was a huge percentage of their existing cash flows coming from people's deposits, and they're somehow booking that in, which doesn't make sense from an accounting perspective. But I mean, is this just an issue of where they're just gonna be completely cash strapped and it's all coming to roost real time here?
Yeah, and it certainly looks that way. I mean, personally, I couldn't believe when Elon on February 28th announced that they were going to close all their retail stores, because March is their busiest month of the quarter. They sell about 75% of all cars, Model S and X, in Europe in March, and it's about 65% in the U.S. So,
Kieran, why is that? Why is there seasonality and is that just people buying cars? Am I not aware of that? Like, is that just?
I think most people buy cars in the spring, like the winter, especially Europe has the same kind of climate that I guess not Southern Europe, but I would imagine during the winter you don't go out and make big car purchases. You wait till the spring. That's like a natural buying season, wouldn't it?
I think there's some seasonality, and there's also just how Tesla does business, and sort of they always try and make the numbers. And it's not just March; it's the third month of every quarter where Tesla has its biggest sales. And so they'll typically do fleet.
That's when they're cooking the books, right?
Come on, that's cynical, Kieran. That's cynical, bud.
You just look at their numbers. That's what they do. That's just a fact. I'm just saying they sell the most of their cars. Either they discount them or they're selling them in fleets. However, obviously you do have the extra seasonality because it's friggin' cold in Northern Europe and the U.S. for that matter, right? We've had these sort of polar vortexes that have sort of ravaged the country, right? I mean, you guys have been in Canada, right? And my parents live in Winnipeg, so. It's been no picnic. I'm sure that no one wants to buy a car then.
Go on. You were talking about Tesla. Something about the fact that that's right.
I was talking about the store closing right into your best month of the quarter, right? Which just didn't make any sense. Obviously, they walked it back 5 days later when they got a $500 million extension on their asset-backed loan. So that's hinting that cash is probably pretty tight. Elon last year said he has to approve all purchases above $1 million personally. Now he's approving all hiring, period, across the company. Like, the whole thing is just in disarray. I don't know when, all the red flags are there. I'm just sort of just sitting back with my long-term puts and waiting for the thing to collapse because it is under a lot of stress, just like the CEO is. And, obviously he's going before a judge or his lawyers are. I don't think anything bad's going to come out of that. I'm not betting on that. I think the story is as bad as it can be. And obviously, I think interestingly enough, is that how it's traded since the rally off the lows. It's gone straight down, right? It's underperformed the NASDAQ by, I think, over 20% now. And it's really just, not performing well because the story is sort of busted and, all of the big institutions except for Bailey Gifford are exiting the stock right now. And even with record retail buying, the stock's still down. So I think it's in a really good spot, especially considering, the sort of fundamental story where they've run through the entire Model 3 backlog, and they're never going to sell the $35,000 Model 3, especially for a net gain. And to me, it's sort of just a waiting game now. I mean, it sort of always has been, but now it's with the story sort of broken, and now you have Lyft and Uber and all these other IPOs coming out, sort of sucking up capital. It's a pretty good time to be short. You can probably wait until it breaks 250 if you really want to be patient. But I believe the fundamental story is strong enough at this point.
So, Kieran, I'm dialing the issue that you're talking about. Are you talking about this $565 million? Let's see which one it is. Isn't this a convertible? Isn't this issue the 1.65s of November 1st, 2019? Is this the one you're talking about? Oh, I see. Okay, right. And it's trading below par. Okay, so there we go. Okay, I got it. So it's a busted convertible because it's like, or not busted, but it's it's out of the money, so it's just trading like a straight bond at this point.
Right, and I mean, speaking about bonds and Tesla's access to capital, I think one of the most I think it's not provable that Tesla cannot physically access the markets anymore, because all they've been able to do recently is access the ABL, the asset-backed lender, which is what you would do in a bankruptcy, right? You would just go to you get a debtor in possession loan from your ABL most likely, which is sort of what's going on. It's sort of like a bankruptcy outside of bankruptcy, right? Where Tesla's like, oh, we're going to close all our stores. Oh, wait, we can't do that. Let's walk that back because we're not bankrupt yet, right? So let's sell our cars now. And then, the whole China loan for the Shanghai Gigafactory was actually, that's being paid in installments for whatever, and it's due in a year, and it's all in yuan. So Tesla can't, as we talked about earlier, you can't bring your money outside of China, right? Once it's there,
right?
So that money is, designed to build the factory itself, and so the Chinese loan is completely useless for Tesla's, liquidity needs overall, and they're obviously doing, the terms are so weird how they're getting it in installments, but beyond that point, really, what's going on is, can Tesla raise more capital? If so, how much could they even raise? And if you go back to August 2017, when they had the unsecured bond raise, they were able to raise, I think, $1.8 billion, but it was not oversubscribed. And in fact, once the issue came in, the bonds immediately dipped. And Tesla, said that it was a courtesy yield that they gave the investors. That's absurd. And this is at the height of the Model 3 rollout. And this is in August 2017. The stock is trading at $380 a share. Why on earth, if your stock's trading at $380 a share, would you not just issue equity, right?
Well, isn't the speculation there that there's an ongoing investigation? And doesn't that require them to file, disclose that? And isn't that the argument of why they didn't do that?
That is definitely the argument. And, so far all actions that Tesla and Elon and everybody involved have made hints that is strongly the case, or something, that there is either an investigation or something is strongly preventing them from accessing the capital markets via, equity raise, right? And you see that right now with the Maxwell acquisition, where Tesla said in January, hey, we're going to buy this, battery company that may have been a fraud. According to some people, we're going to pay, I think 2.5x for this company in stock, and yet it's 2.5 months later and the deal still hasn't closed yet. And Tesla keeps extending it because for whatever reason they can't issue the shares maybe to pay for the deal. And so that's sort of where, so if they could, why isn't that deal gone through yet? Why is it taking so long? We don't know, right? There's just sort of all of these little hints going on. And
forget about hints. There's more than hints. It's like when they say when there's smoke there's fire. There's literally a huge plumes of smoke just billowing from this company all the time. The really surprising thing is how long he's managed to keep it in the air. If this ends up being what all the bears suspect. If this ends up being as bad as the bears suspect, this will go down as the greatest kind of promote in the history of promotes. And we're Canadians and we've seen some pretty great promotes, Briex and or Vancouver. There's been some great promotes, okay? And if this one ends up being what all these bears think, we're gonna look back and say this was unbelievable. Just shocking.
I agree.
And I agree. Going back to, we started the segment off with Jawad, right, saying that it's a big waste of everybody's time, and it has been, right? And he said earlier this week that Tesla is just it's a massive venture capital, but it's done in the public markets, right? And so it's part of this massive VC bubble, right? And the VC bubble hasn't burst yet, right? And if you look at other frauds like Enron or Valiant, right? You look at the stock chart of Valiant versus the XBI or the IBB, and it peaked the same day as the market did. The only difference is when the market, had its subsequent failed rallies, there was no rally out of Valiant. It sort of just trended sideways and then collapsed the next time the market collapsed. And
Yeah, so
You know,
Kieran, that's Patrick and I have this theory that that we're gonna look back, and every great bull has its stock that kind of is the fraud and causes causes it on the other side. The poster boy, the poster child, and we have the theory that Enron is this bull market.
No, Tesla.
Tesla.
Yeah.
Tesla. Have another beer, Kev. So anyways, yeah. So we have this theory that Tesla is going to prove the poster child of this bull market, and it's only when the bull market rolls over that Tesla will really, or either that or Tesla leads the bull market down lower. I'm not sure.
I think it's too small to lead it down, but
I'm not as sure because when
the liquidity disappears, there's no way that Tesla's stock can hold up.
So I completely agree with Kieran that it's being kept aloft by this bull market in venture capital and private equity, and it'll be kind of symptomatic of when the liquidity finally disappears. So it could be that that's the one that's easiest to shoot on the way down, and it will lead, even though it won't be the one that causes the market to go down. It'll be the one that still leads. That's kind of my theory on it.
So
it's sort of symbolic, right?
Yeah.
So to kind of keep in the theme of that beautiful unicorn that is at the intro of our Market Huddle session, this idea that they're taking Lyft and all of these other IPOs public, to me, the biggest IPO pushes are almost always done near where market valuations are at their peak and when the liquidity and bulls are the most frothy, and you can get the most for your issue. And so often when you see a big IPO surge, it's not that far from some sort of key top in a market. Do you think that this Lyft IPO and all these other things are indications that these investment bankers are taking advantage of this market environment because they don't think it will last?
Yeah, I mean, it's also probably a sign that the private capital markets have sort of just had enough, right? There's for these specific companies, the biggest growth stories are like Uber and Lyft and Pinterest, which is literally pins, right? I think somebody joked that you need a pin to pop a bubble, right? These are all coming due right now because they can't, access capital anymore in the private markets. What's so interesting now, is that the public markets are probably more fairly valued than the private markets are. So you're seeing, somehow, these way overvalued companies come to the public markets, and there's this big discrepancy. Normally it's the other way around, right? For the private market, or it has been in the past, right, where the private is more undervalued than the public because, liquidity issues, right? And then when it comes to the market, then it jumps up a lot, right? But this way, it's kind of, completely, the shoes on the other foot, so to speak. And it's a weird dynamic to trade in, to observe, and I'm not really sure what's going to happen with, you bringing on these overweight, overly expensive companies into a market that's more fairly valued, right? It doesn't seem like a very good mix to me.
So, Kieran, one of the pushbacks I have about that argument, and I've heard that, and I agree with you that it does seem like the private markets are fully priced. Yet Lyft comes to market today in the public market. And, in this day and age, I think that most of these companies, these unicorns, although they haven't traded on an exchange, they've been trading in the private market. And unless I'm mistaken, today's price was higher than any price that it had traded at before. Am I wrong? Like, do you know?
No, I mean, that caught everybody off guard too. I was surprised. I look at Twitter, no one thought this would happen, right? That's kind of the crazy part, right? Everybody thought, it would go in the 60s, right? But, it opened at 88. Granted, it did trade down throughout the day, right? It hit as high as 88.5, and now it's at 77.7, right? So, there was a pretty big drop. But, once again, who predicted that Lyft would open at the top end of the range? So there is this sort of froth still, in the market, which is kind of surprising to me and a lot of other people, it seems like.
Yeah, I agree. And that's kind of my pushback on that idea that the private markets are overpriced. And although I love it because nothing would make me kind of happier than seeing all these guys that are all these big kind of swinging dicks that are buying all these big huge unicorns, and I would love them to get stuffed by owning all those things at the highs and then trying to come to the public market and not being able to sell it. But that doesn't seem to be the case, and they just that's what worries me, is that this is going to be the same story, in that the public comes and buys Lyft at an even higher price than all the venture capital guys, and they're the ones that end up holding the bag, and that's what I worry about.
I mean, I think it's already happening, right? I mean, somehow Uber is going to be able to price above $100 billion. I think that's pretty much guaranteed at this point. And Lyft is where it is right now. So those are like the two real big ones. Obviously, I think Palantir is coming down later in the year. There is that sort of feel, right, where everybody's trying to get out right now. What if they are? They might be able to. And I think what's so interesting is when I've talked with people like Worth Ray, and they're like, and they can still see these things, and yet they're still bullish. And they're like, well, I think there's still more blood to squeeze out of the stone. Or, if you get if you somehow can get a currency agreement between the U.S. and China, which, Trump and Mnuchin have both talked about, saying there's a strong currency arrangement in their deal with China, among many other things. I mean, I think then you could see a massive, move to the upside, like we saw it from 85 to 87, where but obviously now the fundamentals are so much weaker. And I think you on the podcast last week were talking about how this could be a 98 scenario. And I sort of discounted that for a while until, you think about if you can get the dollar to drop 10, 20% from here, I mean, everything would just surge. These guys and these, I'll stop there. You go. Sorry.
No, I completely agree.
But the difference is in 98, the dollar was rallying, not dropping 10 to 20%. Okay, so
here we go.
No, look.
Patrick's a big bear, so you have to remember that. He's bearish. He's going to shit all over.
I'm just pointing out that, look, of course, if there's a 10 to 20% drop in the currency, it is going to be stimulative to the stock market. I will totally agree with it. But in 98 and 99, the dollar rally didn't go down, so that wasn't the stimulus.
Yes, I'm just describing the sort of risk-on mechanism. It was obviously different back then than it is now. Obviously, if the dollar rallied 10, 20% from here, we'd all be dead, right?
Well, I don't know about that.
No, I'm
a little bit richer,
Kieran
maybe.
There. No, I'm with Kieran there. The one part that I push against my buddy Brent Johnson's viewpoint is that he thinks that U.S. assets are going to go up, and that's going to mean that U.S. dollar and the U.S. stock market is going to go up at the same time, and they're both going to rip. And I contend that he might be right about one or the other, but he won't be right about both. And I will push back against that. Yeah, I just don't see the scenario where you could get the U.S. dollar ripping for 10 or 20%, and the stock market goes up along with it, and we get a kind of a huge rally. Now, who knows? Maybe I'm wrong, but it just feels to me that's the problem that occurred before. The world couldn't take a stronger dollar, and that is why eventually the Fed had to go on to pause. And for whatever reason, whether it's China or whatever the reason is, that the best kind of rallies occur when the dollar is flat or going down. Like the best rallies in risk assets, because at the end of the day, the America is still the reserve currency, and you need the kind of credit being expanded. And if the credit's been expanded, the dollar goes down. And I think that's in essence why, like if you're bullish on the stock market, you should hope that the U.S. dollar is kind of just drifting lower, because I think that would be the best environment.
Yes, definitely. I agree 100%. I mean, the world's just different than it was in 98 or earlier. Emerging markets weren't as levered up as they were, especially China, right? Especially to the dollar, right? So you just can't see a dollar move like that. The world has sort of hit peak globalization. S&P earnings, 50% of sales come from abroad, right? So you have all these embedded problems in which the system is so much more interconnected, where, I mean, you just can't see that kind of a shift. in the dollar anymore. And it just shows you that the U.S. economy is much more vulnerable to the rest of the world than it once was, right? And that's sort of part of the problem why we have to shift to a different system, because the U.S. is not as strong as it once was, and it can't handle the type of shocks it used to be able to. And that, we're sort of more vulnerable, which makes us more exploitable. And that's just sort of a symptom, or sort of, a fundamental aspect of the new world that we live in, I guess.
Okay. Well, on that, Kieran, you know what? Patrick and I have to go. We're having a meetup and with some of our listeners at a bar, and so we have to get going because we're gonna be late if we keep this up. So I just want to.
Yeah.
No, you don't need to apologize.
Great.
It was great stuff. It was a lot of fun, and I loved it. It was terrific, and I hope our listeners felt the same way, because we really enjoyed having you on, and we're going to have to do it again. So I just want to thank you for coming on.
Great. Thanks for having me, guys. This was a blast.
All right. Thank you very much, Kieran.